if you're saving, about 15% of your pay over your lifetime, that's you plus the company match, you should be able to retire comfortably. And if you're starting at 5, welcome to the Live Greater View, a financial planning podcast produced by VLP Financial Advisors that discusses life, money, and perspective. We help clients live their best life at every stage through our VLP Live Greater partnership process. Thank you for tuning in.
All right, Rose, we have a great episode on the docket for today. We're covering a number of topics related to 401k plans. That's going to be the focus of our conversation today. I thought it would be good for us to talk in generalities about a number of different topics that have continued to evolve over the years as it relates to plans, add a lot of context for what we've seen actually on the ground, and then we'll transition into more of the Secure 2.0 Act changes for 2025.
Yeah, there's a lot to unpack there.
For sure. Yeah. So one of the things that has continued to evolve over the years is auto enrollment. I thought it would be good for us to talk about really what that is, give a little bit of context to what we've seen actually in the workforce, how they interpret that over the years, and then go from there.
Sure. So auto enrollment's changed drastically since it was first brought out as an option from the government, and when we got guidance. And the guidance wasn't always great, right? Which often happens when you have a new regulation, which we can talk a little bit later when we get to Secure 2.0. But so what it was is auto enroll was it allowed plan sponsors and companies to auto enroll employees at a set amount. And at first, there was a lot of hesitation because a lot of companies and owners and people, executives thought, I feel like I'm Big Brother telling people what to do with their money. So a lot of companies didn't embrace it originally. And then we started to see more adoption, more guidance that this is the way that they really wanted companies to go. And then the other issue we saw is that most came out and started auto enrolling at a 3%, right? I guess it's great. 3% is a great start. Yeah. But what we really saw is then we saw participation in the average deferral going down in plans, because what would tend to happen is when employees would sign up, they would sign up to get the full match for the company. So if you had a safe harbor plan where you were matching, the company's matching up to 4% or a combination up to 5%, employees would tend to put in 4 or 5%, sure. Or if you have a higher match.
Right. And if they didn't, they look at that, hey, I'm leaving money on the table. Why would I not?
Right. My line always was, you're not getting the full match. And I've never seen a company come to the end of the year and go, you didn't participate in the 401k. You didn't do the match. Here's your bonus. Yeah. Never happens. So then over time we saw, okay, 3% was great, but we're seeing the average deferral going down, which is not great. And then more guidance came out, and then more and more plan sponsors and we educated our plan sponsors like, look, let's get them to the match. This is great that you're auto enrolling them, but they're missing money like this, and there's only so much education. You can't reach anybody. Yeah. And the beauty of auto enrollment, you and I have talked about this numerous times, is, and part of the beauty of why they encouraged auto enrollment is nobody has to do anything to get in, right?
And a lot of times, wherever they start at, that's what they'll be at for, a year, 2, 3 years after and beyond. Whatever they say, hey, I have so much stuff coming at me when I'm trying to learn this new job, enroll in my other benefits, take care of, what I need to from a work perspective. Please just take this off my plate and take care of it. So a lot of times, whatever you actually start at, if you say, hey, 3% would be, was not optimal, you need to save more. People say, okay, help me, get me there. And then 5-10 years later, you go down and you're like, aren't we, you glad that we actually went through with that?
Yeah. Yeah. And I think that's the beauty of auto enroll. I mean, you and I have talked about this numerous times. You're on site, you're at 401k, someone comes up to you and says, hey, I want to enroll in the 401k. My first question always is, how long have you been here? Because, a lot of places have a waiting period and they go 5 years. I'm like, great, you're already in the plan. They're like, what? I'm like, yeah, you were auto enrolled 4 years ago. Yeah. There's nothing more exciting opening up and they see a statement of balance and they're like, wow, I didn't even notice.
Found money.
Yeah, found money.
For sure. So auto enrollment, that's great context. What about the auto escalation features? That's something that's become a lot more prevalent.
Yeah, and I think it's really key, especially if you, depending on your company and your plan and how many employees you have. This is a great opportunity because if you look at the statistical, the history, if you can get if you're saving about 15% of your pay over your lifetime, that's you plus the company match, you should be able to retire comfortably. And if you're starting at 5, how do you get to 15? Yeah. And so that's the concern. So the auto increase, which I think is great, especially when you're starting out young. And we'll tell the younger ones, like, we're going to get in. And then the auto increase allows them to go up 1%, 2%, 3%. They get to designate and then cap out at a certain number. Most plans cap at 10%, but there are some, we are starting to see guidance lighten up to raise that cap.
Yeah, for sure. And it's amazing how people do not notice that.
Yep.
A lot of times they're just, going through, their role at work and they're saying, okay, I'm getting a bump in pay. They'll get, somewhat of a bump, and that will obviously flow through to the 401k in the auto escalation. And then you fast forward 3, 4, 5 years. So like, oh, I didn't even know that was going on. I didn't even notice it, which is a great thing.
Absolutely. It's a great thing. And, and I always say, it's like, you just got to stop at Starbucks once less this week. We'll just tuck that into the 401k. Right. Maybe it's a few stops. It depends on, your income.
The person. Yeah. Cool. Well, so auto enroll, auto escalation. Let's talk about the qualified default investment alternative, or QDIA is the acronym. What that really started at, a number of years ago, and what that looks like today.
Yeah, I mean, it's that market's evolved because years ago there was only limited options, right? There was a few companies who were doing what's called the QDIA, and basically it's going into a default fund that's being managed by one of the larger companies. I mean, all of the big companies have them: Fidelity, Vanguard, American Funds, all of them, T. Rowe Price. And so if you are, here's how I always explain it to the participants. Is it finds the date closest to your 65th birthday, and someone at that fund company is managing those assets for that date. So if you're 20 today, 25, it's very aggressive. It's going to be aggressive for a long time because you have time for the market to go up and down. But as you get close to retirement, that's when it becomes more conservative. The nice thing about the QDIA is the paralysis that you would see when this was one of the reasons employees may not enroll. As you talked about, it's complicated. They get in, they have all these other things onboarding in their life, and they don't know what to pick on the investments. This is not what I do. I always use the analogy. It's like me changing my oil. I take my car in. I don't know what oil they use. I don't know what filter, but I know if they don't put the right stuff in, my car's not going to run. So unless you have an electric car, so I guess you don't need oil, but, I'll have to change my analogy. Yeah. But, so the QDIA, it was that default option, because what it used to be is the default option used to be a money market or a stable value fund, which maybe back in the 80s was great when interest rates were in the 13, 16% range. But when we had that lull of a period where interest rates were literally zero, that was an issue.
Terrible. Yeah. And now that we've seen really a full market cycle of the target date funds being used for QDIAs, it's interesting because behaviorally, back in the day when people would have to pick their investments and whatnot, they kind of felt that burden, that onerous to do that. And then when we'd have volatility in the market, people would go in, want to make changes, or at least think, hey, should I be doing something? With the QDIA option, where they say, hey, I'm moving this on to somebody else's plate, behaviorally, that's been a really good thing, because now when we see volatility, we don't really see that sort of emotional aspect as much as what we did back in the day. Yeah,
this is probably before your time. I always use the Ronco analogy. If you ever, if you watch the infomercials, he used to have this, you could set it and forget it. That would be the Ronco way. So I think that's the nice thing about the QDIA. It allows participants to it aligns their investment time horizon with a portfolio that's going to be managed with more risk when they should have it, and less risk when they shouldn't.
For sure. Yeah. Cool. One quick thing that I wanted to talk about is just the beneficiary designation.
Yeah, that huge.
That is something where across all of our plans, typically the trustee reviews at the end of the year, we come to them with a beneficiary capture rate. We identify, participants in the plan that don't have a beneficiary, just to unpack that, clearly beneficiaries from other work benefits do not come onto the 401k plan. Nope. A lot of people do not realize that. They just say, well, I'm signing up for all these other benefits. I thought they'd go on to that, which is not the case. And then we think that it's best practice just to have those beneficiaries reviewed at least once a year. Things change in people's lives. It's just at that time of year or the beginning of the year where they're looking at big picture stuff that we say, hey, while you're working on this other stuff, just double check that. It's just good, good practice.
Yeah, and that's one of the pitfalls of auto enrollment, right? You can be auto enrolled in your 401k, you can start having a balance, but you never logged into the system. And if you didn't log in the system, in this day and age, everything is electronic. Paper beneficiary forms are gone by the wayside. So, you have to log in and designate your beneficiaries. And it's key. And as you related to, one of the biggest things we see is, especially if you're in a business where you have high turnover, maybe your sales team, whatever that scenario is, you have seasonal work, but they end up with a balance. These people don't have beneficiaries, and then something happens. That's one of the biggest things that we see. And, the average capture rate in a 401k plan is below 60%.
It's wild.
Yeah, it's crazy. So think about that. And you think about all the assets that are in 401k plans out there.
Yeah.
40% of it, 30% of it's out there with no beneficiaries.
Yeah.
So it is key. This is certainly from a plan sponsor perspective, because as a plan sponsor, this becomes a headache when someone passes.
Yeah, for sure.
Because then it becomes you're now up to your neck in paperwork with trying to find out, the estate's getting involved. We have these accounts that we have to figure out who needs to go to. So it's definitely a key that making sure you have the right, group and team that's sending out, there's ways to get around to get education. But if you have boots on the ground, that's the most effective way we found of getting beneficiaries in the system.
Yeah. And to be in that HR role, you already have enough on your plate. And now you're having to deal with obviously something that's sad, but now you're dealing with families and this and that. And you're like, whoa, I didn't necessarily intend to sign up for all of this.
Yeah.
It's something that could easily be avoided.
Yeah. And as you alluded to, it's something, making sure you have meetings with, if you are the plan sponsor, if you're in charge, if you're the HR and, you've got fiduciary risk here in the plan, making sure you have a meeting every year with your partners to say, where are these numbers? How are we tracking? What is our solution? And how do we make sure that we have good QDIAs? Our auto enrollment is capturing everybody. And again, where are we on our beneficiaries? Who do we need to get caught up?
Right. For sure. Great. Well, as well as, sort of the big picture planning for organizations, a lot of times, either late in the year or first quarter, companies will take a big picture look at the record keeper that they're using for their 401k plan. We could do a whole separate episode on the ins and outs of all of the record keepers. Being independent, we work with all of them. But I think it would be good for us to spend just a couple of minutes on the main things to consider and just give a little bit of context for somebody that may be going through that process.
Yeah, I mean, record keepers, they come in all shapes, sizes, and, capabilities. And so do businesses. So the main thing I think you got to do is you really got to understand, one, a lot of times is, how is your payroll going to work with them? Is this going to be a manual scenario where you're going to have to be more involved? Is there a way to electronically transfer data? Can your payroll work seamlessly with it? Because that is a headache, right? And this is where we tend to see most of the issues pop up in an audit. Is that someone didn't get the, money was withheld from their paycheck. It didn't make it in their 401k. It wasn't invested in timely time. So, it's important to know what your options are in funding the 401k. Mm-hmm. And that's going to be, the DOL says it should be administratively as possible after your payroll's run. So, they say 3 days. And usually when we see an audit finding, that's one of the number one reasons. It didn't get, payroll was run, it was cut, it wasn't funded in time. So again, how is your payroll going to work with this company? What is the process? I think that's a big thing. What are the options? Mm-hmm. Fees are big. Mm-hmm. What is your website? What's the ease of use? Is this going to be a hindrance for getting employees to get in to put their beneficiaries in? Yeah. We've worked with some plan sponsors and 18 clicks or whatever. I mean, it's not that bad, but there's a lot of clicks to get to the beneficiary, where it tells you don't have a beneficiary. You click at the top and you enter it. So, technology's big, funding, how that's the communication and just the support you're going to get, because they're all not built the same.
The service models are different.
Yeah, 100%.
And obviously that is really the takeaway that we leave sponsors with is there has to be the right fit. And that doesn't mean it's the least expensive or most expensive. It has to be the right fit for your size company, turnover, technology expectations from your workforce, all of those certain things. The fee aspect is interesting because there are certain record keepers that are designed for smaller businesses where it makes a lot more sense. And there are other record keepers where they cater to bigger
big businesses. Companies. Yeah.
You just don't, and there's different formulas to get to, both of those. You just don't know until you go through that process, but just great context to add there.
Yeah. I think it's really important if you're comparing, one of the things we do, often with our 401k plans is we do a comparison of their current sponsor. Are they still competitive? Do we need, is there a chance that we need to go back and ask for fees be reduced, not only on them, but on us? We have to look at all of that, right? What's the service model? What are they doing? I think that's all key, but getting a demo of their technology is massive. I think that, what is your employee going to experience? Yep. what is your HR or your payroll department going to experience when they have to do this? I think that is just massive, because we've seen some plan sponsors, in works where it works beautifully. It's a great marriage. And then there's some where we're like, this should not be this difficult. Yeah. So it's all about finding that right fit for you and your company.
Yeah, for sure. And then the service model differences, those are massive also. In just to go into, some of the specifics of that, in some instances, you'll have a service team where it's, hey, if you need something for the plan, call this specific number.
Yep.
There's a group, they pull up your plan by plan number, and that works for a lot of companies because their plan's not that complex. It's relatively, concentrated with ownership, and that's great. It makes sense from a cost perspective to go that route. Then there's other models where it's, okay, you have a specific person, a specific contact that knows your plan in and out. They have a team of people. Obviously, it's a little bit more expensive, but in some cases, it could make a lot more sense.
Yeah, especially if you've got a lot of moving parts. We have a lot of plans that have a lot of moving parts, and that has been the model. In some cases, it's a little bit more expensive, but again, now that company doesn't have to hire someone else to fill in those gaps. So, there's a trade-off.
Cool. Yeah. Well, that's awesome. I'm happy that we bounced around, to those different things. We just thought it'd be helpful to share. So let's transition into the aspect of Secure 2.0. Let's talk about really what it was in general, and then talk about some of the main things that are going to change in 2025.
So this was an extensive retirement plan legislation. It's so extensive that it's taking years to put the implementation in it. And not only the years, but then they keep delaying things because, some of the parameters they had written into this law just couldn't, they didn't have the technology built to be able to meet these. We'll talk a little about some of those coming up. There was over 90 changes in this retirement planning and tax law, to be like I said, implemented over time. Effective dates we talked about have been delayed, but it's been pretty massive. Some of the bigger things we'll talk about is, auto enrollment, how that's going to be impacted. That's going to be one of the changes coming in 2025. They expanded some of the options on loans. And there's been some changes on the distribution. So now these are all optional. Not all plans have added them, but you can add in to allow a certain loan up for adoption, for domestic abuse, for emergency. The numbers aren't massive, but it is, you have to be aware of it because it can be an administrative scenario that could get out of hand depending on your plan demographics. One of the bigger things is the cash out. So, you can, if you have a lot of turnover and you have participants with small balances, you can cash them out or roll them to a smaller IRA. If it's under 5,000, that was the roll. That is expanded to 7. So there's been some things. It just allows you to keep your plan a little cleaner, but a lot of change over this time frame.
Yeah, for sure. And there, just to be frank, this has created so much confusion because they initially just came out and said, hey, being the DOL and government just came out and said, hey, here's the playbook. And then it really kind of sent everybody into a frenzy of like, whoa.
Right.
That was
you had every major plan sponsor down in DC.
Yeah. Like, what are we doing? How are we going to do this? And then, like you said, they've slowly but surely walked back a lot of this. And then some of the pieces are falling into place. Some are pushed further into the future. One of the big ones for next year, you alluded to, the auto enrollment feature, that will be a requirement for plans starting next year that are established from 2023, 2024 and beyond.
Right.
So that is something where they said, hey, if you're a new plan in Secure 2.0, you are going to have to enroll employees at a minimum of 3%. They really started to move the goal line on that and said, well, it's not required. Next year, they're officially bringing their foot down and saying that is a requirement.
Yeah. So if you have a business with more than 10 employees, and if you have less than 10 employees and you haven't been in business for 3 years, you're going to be excluded. There's a few exclusions in that, but basically they say if you've established a plan going forward after this date, after December 29, 2022, you must have auto enrollment starting next year, and it must be at 3%.
Right, non-negotiable.
Non-negotiable.
Yep, for sure. So, and obviously we unpacked why we think that's a good thing and some of the ins and outs of that. So, the second thing is this special catch-up provision.
Yeah, this one's an interesting one.
Yeah, this is something where it's a good thing, but it seems very arbitrary, and it seems like it's going to create a lot of confusion.
It seems going to be fraught for issues in the payroll.
There's kind of already things that sound like this that have different ages. And this seems like it's, like you said, a recipe for a lot of confusion.
So let's start with what the catch-up is now, right? So if you're under age 50, you get to put away $23,500 in 2024. If you are over age 50, you got to put an additional catch-up contribution of $7,000. So that was anybody. If you were 50 and older, you fell in that. This new provision, if you are between age 60 and 63, not 64, not 65, but 60 to 63, you get to put it away up to 50% more than the average catch-up provision. So, all right, let's do the math on that, right? So it's if you take the $7,500 is the catch-up provision. My bad. It's at 50% of 7,500, and then add it. It's $11,250, but only if you're 60, 61, 62, or 63.
Yep. Yeah. And the age band 60 to 63, if you're asking, well, why is that the case?
Right.
There is no answer.
There's no answer. We can't find one.
It was just arbitrarily picked as something that says, hey, this is who we want to target. So again, the takeaway there is the big ages from a savings perspective, 50, the regular catch up, 60 is this special,
but only for
what they're calling it.
Yeah. But only until age 63.
For 3 years. Yeah, for 3 years. So good deal. Okay. The next one we've talked about in some of our prior episodes, this is the 10-year rule related to inherited IRAs.
Yes.
So there is a lot of planning, that we talk about around that. We can, discuss that briefly, but this rule really has the government bringing their foot down on the required minimum distribution piece of that rule.
Yeah, so they came out and said that if you inherit an IRA and you're a non-spouse, so if you are a spouse, this doesn't apply. And if you are within 10 years, if you're the beneficiary and you're within 10 years of the owner, it doesn't apply. A couple other scenarios if you have a special needs trust. But if you're anybody else, if you're the child, cousin, sister, whatever, friend, whatever you are, you need to take all the money out of the inherited IRA or the inherited 401k within 10 years. Originally, it was just had to be all distributed in 10 years. And then we got guidance that, you have to take required minimum distributions. They did waive them again in 2024. So 25 is not a year. But the real issue is if you keep waiving them, and this rule came about in January 2020, 2030, if you inherited an IRA or a 401k in 2020 and you haven't taken any RMDs, all that money has to be distributed by 2030. Yep. They haven't pushed that back. They haven't changed that. So, if you inherit $1 million IRA, this is common these days. I just got off the phone with a client who was a beneficiary of $1 million IRA, who's 54. She's still working. They're in their peak earning years. So we need to figure out how to take this money out because we're going to push them into a much higher tax bracket. They're going to be at the top of the tax bracket. They're already at a high bracket. Maybe they retire early so we can distribute more money later. But this is a real issue. And I think that was the intention of the law, was to get the tax dollars.
Yeah.
So, next year, current guidance is they will have to take an RMD. So they will go to the single life tables. They'll find their age. There'll be a calculation. The advisor or the company you're working with should be able to help you figure that out. But, this 10-year rule is really going to change the dynamic on the tax planning for these distributions.
For sure. And we've, obviously had that conversation within our financial planning meetings for clients of saying, hey, this is, like you just said, a real issue. And in some cases, one of the other things that I wanted to point out is the earnings dynamics of their children.
Yep.
Some children are in a higher tax bracket. Some children are in a lower tax bracket. We've had instances where we say, okay, well, if you have this non-retirement account, it makes sense to leave, child A on. If you have this retirement account, maybe it's child B.
Yep.
That's just part of that conversation. So like you alluded to, it doesn't help that if you do the math, it's exactly where they're oftentimes in their peak.
Yeah. So this will also bring it to the forefront, which is also one we didn't talk about, which is coming in 2026, is Roth. Mm-hmm. In the Secure Act 2026, so we're getting a little ahead. The current guidance is that if you're over age 50, your catch-up provision has to go to Roth if you make a certain level of income. Most people are going to fall into that category. Mm-hmm. So anyway, the Roth having a Roth IRA or Roth 401k, no tax when it has to come out. The beneficiary, nobody has to pay the tax, whether it's the person who owns the account or the beneficiary. But, we're seeing the first generation, in my opinion, who have really, the 80s is when the 401k really came about. So the group of people who are really starting to retire, who their entire savings has been in this mechanism, which is could be in the multi-million dollars. And if you have one child, if you are husband and wife both worked and you have one child, this could be a massive tax planning, because the thought process was, I keep putting money away, I'll be in a lower tax bracket later. Maybe they are, maybe they aren't. But now this $4 million has to pass to somebody and they have to take the income in 10 years.
Yeah. And a lot of times also when people see an account like that, or you reference $1 million, they'll do the quick math and say, it's $100,000, but that doesn't really get to the heart of it, because the money will continue to compound. It will be much more that
it goes against my old saying, it's not the first double that counts, it's the last double. Right. So if you have $1 million doubles to 2. Yep. Well, it's a different, for sure. If 2 doubles to 4, if you average 7%, 10 years, you get a double. So, I think there's a lot of planning and conversation to go around this. So I think again, getting back to from the plan sponsor perspective in HR is, how do you get this education to the employees to help them understand, yes, you got auto-enrolled, or, what are these options, all these changing roles. Wait, I'm 61. What does that mean? Yeah. Those types of things. So lots of moving parts. And I think, there's a lot of opportunity to provide education and help your employees get on a better path and have a better forward looking.
Cool. Well, that was a lot of fun. I'm glad we hopped around and unpacked, the things that are on our mind within the space, and then things to come in 2025. So as always, we just ask our listeners, if you found value in this, please feel free to pass this along to your colleagues or friends. Yeah.
And as you're looking forward, if you are a plan sponsor or on the executive team and you're looking and saying, hey, this hit home, there's a couple things that really, we need to think about. We do love to have that initial conversation. We do a free conversation just to see, hey, where are you? Maybe you have a great plan. Maybe you need some guidance. Maybe there's some things you can enhance. We'd love to talk to you and see how we can help.
Great. Thanks, Charles.
Thanks. Thank you for listening to this episode of the Live Great Review. If you like what you heard, please subscribe to our podcast on iTunes or Spotify and recommend our podcast to family and friends. To learn more about VLP Financial Advisors, please check out our website at vlpfa.com. Thanks again.
And now for our necessary disclosures. Securities and advisor services offered through Cetera Advisor Networks, LLC, member FINRA SIPC, a broker-dealer and registered investment advisor. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. The views stated in this podcast are not necessarily the opinion of Cetera Advisor Networks, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned. Due to the volatility with the markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results.